Hi everyone. I received a lot of questions recently asking for ETF suggestions. So I'm going to share my ETF spreadsheet, which has some of the largest, most diversified, and lowest fee ETFs. When it comes to finding an ETF, it's actually not that complicated. You want to look for three factors. One, you want it to be large and liquid, which means you can buy and sell pretty easily. You want it to be diversified, and you want it to have low fees. So let's get right into it, and I'll talk you through my spreadsheet and how you can use it as well. So if we look at the spreadsheet, let's just talk through each column from the left to the right. So on the most left column, we have the name of the ETF, pretty self-explanatory. Then the next column over, we have the industry. So for example, we have the S&P 500 ETFs here. We have QQQ. We have some energy ETFs like XLE. We have utilities ETFs like XLU. And the list keeps on going. The next column over shows the largest holdings in this ETF. The entire point of an ETF is to give you diversification so you don't have to worry about the individual stocks within the ETF. So if we take the S&P 500, for example, nowadays it's actually pretty tech heavy. It's 32% tech. And all the largest names, Microsoft, Apple, Nvidia, are all tech names. You'll see that it's somewhat concentrated, but no individual stock is more than 10% of the ETF. So it's relatively diversified as well. Then if you look down here, there's also energy. Some ETFs and some industries have a few companies that are especially large. One example is energy, where Exxon is by far the largest stock in the energy sector. And you see that in the weighting in the energy ETFs. This is important to know. If you buy XLE, for example, Exxon is 27% of that ETF. So if Exxon stock falls 10%, your overall ETF will also fall 10% times the holding amount of Exxon, which is 27%. So the overall ETF price would also fall about 2.7%. So that's why you might care about the individual holdings within an ETF. These next columns show the annual return of each of these ETFs, excluding the annual dividend. So just take SPY, for example, which is an S&P 500 ETF. You can see that over the past 30 years, up until this past Friday, the annual return from price appreciation, so excluding dividends, is 8.5%. That's pretty good, considering add on another 1 to 2% from the dividend yield, and all of a sudden you're at almost a 10% annualized return. Similarly, you can see QQQ, for example, over the past 1 year has returned 30%. That's because tech was down quite a bit in 2022, and then 2023 you kind of saw that rebound, hence the 30% 1 year return. And you can see all the different returns over 1 to 20 years to 30 years based on different industries. Energy, for example, over the past year has done pretty well. Over 20 years, it's been closer to 5%. Similarly, utilities has kind of consistently been around this 5-ish%. It's a pretty defensive sector. Healthcare has been closer to the S&P average return over the period of 20 years. The next column over is the dividend yield. And the reason why the dividend yield is important is because some folks really care about annual dividends. That's basically cash flow that comes into your pocket. Certain ETFs have higher dividend yields, just as certain industries have higher dividends. For example, the S&P, on average, it's a 1-2% dividend yield, closer to 1% currently. QQQ, which is more tech-focused, 51% tech, has lower dividend yield because historically, tech stocks have been more growth oriented and generated less cash. So there hasn't been as much cash to pay dividends versus, let's say, for example, energy has a 3% dividend yield. Same with utilities. Banks also have a 3% dividend yield. So these are industries that have historically produced a decent amount of cash. So they pay higher dividends, but maybe there's less price appreciation because the companies aren't growing as much. The next column shows the 10-year return, so price appreciation in the ETF, plus the current dividend yield. The reason this may be important is, one, it shows total returns, and two, certain industries which have higher dividends, it's possible that even though they pay decent dividends, there's been less growth overall in the stock price of the ETF itself. So you care about both the dividend yield as well as price appreciation because that's your total return. The next column over is the expense ratio. The expense ratio is basically the annual fee that you pay to the person who's managing the ETF. Why does that matter? Because you want low fees if possible. You can see here, for example, two S&P ETFs. One's SPY, one's VOO. And SPY actually is more popular than VOO, but the expense ratio is less for VOO. And the two ETFs both are designed to track the S&P index, so should be pretty similar. Here's another example. Most people have heard of QQQ, but they haven't heard of QQQM. Now, the reason this is interesting, QQQ and QQQM are exactly the same, and they're managed by the exact same manager, Invesco. But QQQM has a lower expense ratio than QQQ. Why does Invesco have the exact same ETF with a lower expense ratio? Well, what happened was with QQQ, the expense ratio of 0.2% is actually decently high. The VOO and SPY expense ratios are both substantially lower than QQQ. And what happened is because of QQQ's higher expense ratio, customers were withdrawing out of QQQ and going to other providers of ETFs. So Invesco thought, okay, we want to retain these customers. So how do we do that without actually decreasing the expense ratio of QQQ? They don't want to actually decrease the QQQ expense ratio because there's so much money in QQQ. So they'd make a lot less money overall. So what they did was they perfectly replicated QQQ by creating this new ETF, QQQM, which has a lower expense ratio. So now people who care about lower fees can go and buy QQQM instead of taking their money to somewhere else. So again, two ETFs exactly the same, but QQQM has less fees. So I think that's just an interesting fun fact. The next column is the S&P 500 correlation. What does that mean? The correlation basically measures how closely an ETF tracks the S&P 500. Why does this matter? If there's a higher S&P correlation, that means when the S&P goes up, so will that ETF. When the S&P goes down, historically, that ETF has also gone down. Most people hold a S&P 500 ETF. Maybe you want some ETFs as well that are less correlated to the S&P 500. You can see here, for example, QQQ is actually quite highly correlated to the S&P 500. But then if you go lower, energy is not especially highly correlated. You can see biotech is 0.5, insurance is 0.3. Being correlated is not necessarily a bad thing. It's just something you should be aware of. For example, if you're holding an S&P ETF and a QQQ ETF, and the S&P falls by a lot, you should be prepared for your QQQ ETF to fall a lot as well. And hopefully at that point in time, there's no reason you need to sell some of your holdings, for example. If we go to the next column over, this shows the overlap between a specific ETF and the S&P 500. So how much in market cap is the same between the two ETFs? Again, this is just a measure of diversification. Of course, the S&P ETFs are 100% overlapped. QQQ, QQQM, because they're both tech heavy, have almost 50% overlap with the S&P 500. Then as you get into some of the mid-cap ETFs, there's less overlap between those ETFs and the S&P. Final column I've included here is the total assets in an ETF. This is just generally to measure how liquid an ETF is. The more assets in an ETF, the easier it is to trade in and out. In general, at the sizes of these ETFs, they're all going to be quite liquid for regular investors, such as ourselves. You can see here, for example, there's over 500 billion SPY versus some of the smaller ones here, like QQQM, 28 billion. We're not moving these types of volumes, so it's not particularly important, as long as it's not too small. Okay, hopefully that was a helpful overview of, one, the spreadsheet and what the columns actually are telling you in it, and two, some of the criteria that are important when you're evaluating ETFs. You can take a look yourself at some of the different industries that I show in the spreadsheet, and feel free to give me suggestions. Because I've automated the formulas in the spreadsheet, it's very easy for me to add in ETFs that you think are interesting. In the future, I'll make more videos about ETFs, especially talking about specific types of ETFs that people seem interested in. For example, ones with high dividend yields, just to show some of the trade-offs you make. Sometimes when you choose a high dividend yield ETF, you give up some of that price appreciation. In the meantime, feel free to suggest any ETFs you'd like me to evaluate, and I'll plug them into the sheet and you can see what their historic return has been. Again, historic return, not necessarily indicative of the future. For example, the highest performing one right now has been semiconductors. That does not mean that semiconductors are necessarily going to have very high returns going into the future. It just happens to be, one, cyclical in terms of an industry, and two, industries come and go over time as well, which kind of is the advantage of some of these larger, more diversified ETFs, such as the S&P. Thanks for listening in. I'm Nick, and I've worked in finance for almost a decade. If you enjoyed this video, please give it a like and follow our channel for future videos. You can check out our WeChat group for more wealth and retirement tips. Talk to you next time. Bye.